Welcome to the daily update, where I'll go over the action in the market for Tuesday, September 17th, and then we'll see how things look for Wednesday, September 18th. For those of you that watch the videos on a regular basis, I probably sound different. I'm currently traveling right now, so I don't have the usual equipment that I have when I record the videos. Some of you might think it's better, but it's going to be different, whether it's better or worse than what I usually do. Well, okay. And I did not publish a video for Tuesday. I was traveling that entire day and I just was not able to put one together. We're now waiting on the Fed, and both in Monday and Tuesday sessions, we're positive right now, but the market is really on hold to see, okay, the Fed's going to cut rates in Wednesday's session, but by how much? Over the weekend, it was 50-50 between 25 basis points and 50 basis points. Now it's leaning more towards the 50 basis points. But what kind of message is that going to send the markets? And what is the Fed going to say in their announcement? They also have this little report that they come out with. And then what is Chairperson Powell going to say at the press conference after they make the announcement? So the market's in kind of wait and see mode, but we're still maintaining this positive stance. At the same time, we're coming into a pretty severe time of negative seasonality for the S&P and for the whole market in general. It does not mean that it will automatically go down. It just means that usually when you take like 75 years of data and put it together, this time of year, especially during an election year, can be negative for the market. And it typically goes from about the middle of September into October, and we'll see. Are things going to be different this time? Is the market going to really shoot to the upside and like that, and then spend time after that selling off? These are the things that we're going to be watching for. Are they going to come out and say something that the market isn't going to like, and then the market's really going to tank and we're going to decline from there? Or will we see buyers try to step in and take prices back higher? So these are just some of the things at least I'll be watching for, and I'll be pointing out in the videos. Okay, I do have a thing called the SPXInvesting Program. You're more than welcome to check it out. In fact, at the end of October, I'm planning on doing a live class, it'll be a basic class about the stock market. So if you're brand new to this class is designed for you. Now, there is a basic class already on the YouTube channel. And there's an updated version of the basic class on the website you can watch, but that's longer. This will actually be a live session where you can see me, you can ask me questions. It's not going to cover all of the same material is in depth. I'm just going to pick out some of the areas that are probably most important and then use the pre-recorded version of the class just to use more like a reference of something. But that's one of the things that you will have access to, is that live class. And then I'm going to be doing other live classes after that, talking about different strategies that you can implement. I have a really in-depth course on technical analysis that I'll be putting out there. And then mental analysis, how you can try to overcome your emotions and what things I really look to implement. And then there's other things that are involved in the program as well. But feel free to check that out. There's a link to the website. There's a link that tells you more about the program, or here's an email. And then one of the benefits that you get from being a member is that you get immediate access to the videos when they are available. And then the daily video is the real foundation of the analysis that I do with all of the videos that I did over the weekend. Those are meant to supplement the daily video. Okay, so let's go back and talk about what happened. Since I didn't do a video for Tuesday, I'm not going to go back and talk about Monday, but there's a few charts, especially in the Isabel Net part of the video, that I'm going to show that were from Monday as well as Tuesday. But really, we're just going where things are at this point after Tuesday's close. So we ended up having a higher open, and we got above R2 at 56.56, and then we declined back below R2. And we kept declining. We got down below R1 at 56.43. We broke below the unchanged level to go negative, and we ended up finding support at the daily pivot at 56.25. And then we were able to come back up to the unchanged level and close slightly positive on the day. But real wait and see for right now. We were up 0.03%, just virtually unchanged. Volume is below average with a lot of folks waiting in anticipation of what's going to happen on Wednesday. Now, whatever does happen, whether the market screams up or screams down, what you'll find a lot of times is in Wednesday's session, there might be the usual gyration after the open, and then things might settle down and pretty much chop sideways until the Fed comes out and makes their announcement. Now, we've seen exceptions to that, but typically that's what you'll see. And the initial reaction, sometimes it's the same going forward from there for the rest of the day, but there can be an initial reaction and then another reaction that goes in the opposite way. And then the market may settle into something while the press conference is being done. So again, I'm going to be focusing on the close. Where do we look to close? And then because the Fed is doing something for the first time that they haven't done in over 2 years, and that's either raise or lower rates, there might be some overflow into Thursday's session because people are going to, what'd they do? And then they're going to come home and make their decisions based around that. So there can be some carryover reaction on Thursday as well. And we're still positive in the short, intermediate, and long term. I'll go through those different things, keeping an eye on the geopolitical events going on in case they impact the market, but not really impacting things right now. The Dow did set a new intraday all-time high, not a new closing all-time high, but an intraday all-time high. And the ADX is now cross positive, but we're still not trending at this time. It looked like we were developing a negative trend. Then last week, things started to improve. We've now turned back to positive, and the ADX hasn't really figured out, okay, is this a trend or just some kind of a short-term reaction? Now, the other charts are looking more positive, but the ADX is not quite sure yet. We did have a Hindenburg-Ullman signal. That's negative. The perma bears are loving that one. It was confirmed on 9/12. It was first generated, I believe, on September 5th. And it has a second signal needs to be triggered within 20 trading days. And that has now happened. Now, on a short-term basis, we have the Stochc RSI, Williams percent R, and the stochastics. Now, you can look at them as being extreme positive, or you can also say, wow, look at that short-term momentum. It's pretty positive. Intermediate term, a new addition to the list, the CMB composite. Another new addition is the 50-day exponential moving average on the S&P itself. Another new addition is the Erin indicator. After going flat there for a while, it's finally showing us something. The Sean trend meter is new on this list. And the bullish percent index, this is one of the primary indicators that I follow. And it's now getting above that extreme positive reading. And the ultimate oscillator, which is a secondary indicator. On a long-term basis, we're looking extreme with the 150 and 200, which could also suggest good long-term momentum. And I haven't changed this scenario for right now. We'll see what changes will happen after Wednesday's Fed announcement. The dollar was up and interest rates were up. This might have put some pressure on stocks because the dollar going down and interest rates going down will usually have a positive impact on stocks. We closed at 3.65 after Tuesday, where we had been at 3.62% after Monday. And we're still inverted with the 10 to the 3-month yield curve. I'll show you that chart. And we're still following the 10 to the 2-year yield curve. That still remains uninverted, or it's going back to normal. Sentiment is positive. We have seen a real improvement there. We're at 56, where we had been neutral. We came up from a reading on Monday of 54. And we're still not trending, though. That's what I was talking about with the ADX. But we're positive. The green line's above the red line, but we're not above the moving average, and we're not above 20. We're still biased with our bias is positive for right now, and our momentum is positive for right now. But that could shift depending on how the market takes things. You could make a case that we're going to just bust on up from here and set new all-time highs and just keep going. That is a valid case. Based on our charts, we're looking positive. But then when you look over and at the seasonality of what often happens during this time of year, you could also make a really solid case that, yeah, we're due for some kind of a, maybe not a huge decline, but something that will scare people out of the market that just think it's automatically going to go up from here. You could make a case going both ways now. Okay, we did get retail sales. That was the big report, and that's what the market initially reacted off of. It was up 0.1%. That was stronger than the down 0.2% that they had expected. So people are still going out and buying things, and that's suggesting a good economy for right now. Now, it was weaker than the 1.1% we saw last time, but it came in stronger than what they thought it would be, and the market took that as positive. When you take out autos, we were up 0.1%. That was less than the 0.2% they had expected, and down from the 0.4% that it was up last time. Industrial production came in at 0.8. They expected it to be at 0.1%. Last time it was down 0.9%. And capacity utilization is at 78. They expected 77.9. So this was stronger than expected and up from the 77.4 we saw last time. Business inventories, and I don't have a chart for this one, but I do have a few of the other ones. We were up 0.4% as expected and up from the 0.3% we saw last time. The NAHB housing market index came in as expected at 41, where last time it was at 39. Okay, so here are the core sales year over year, where we're flattening out here, but we're still positive when you do it on an annual basis here. And we declined, but we were still positive on a month over month basis. Here's industrial production is going up a little bit, just slightly, but we've been dancing around the zero level. We're just slightly positive now. And the capacity utilization, when we're at 0.8, that's when the US economy anyway is considered to be at full capacity. All the factories that can be used are being used. All the people needed to do things. Well, we're just under that level right now. And it's actually been dropping off just a little bit, but also flattening out and not really declining all that much currently. So I keep an eye on this, and we want to really see if we see these both going down, that could suggest a real weakening economy. And then here's why I have a hard time saying that. Capacity utilization, just a little bit over, or right now it's at that 78% level. And then month over month, we did see a real pickup in production here. And then I do have extra charts because I couldn't do a video for Tuesday. So I have the charts for Tuesday and then the charts that would apply just to this video, just to go through these quickly. Here's the overbought, oversold composite. We're coming in at 79.5. We had dropped down in here to below 50. Well, now we're starting to get above that 80 level now, but we could still go higher than this. When we really get more concerned is if we go above 90. Okay, and then you see the blacked out area here. This just shows historically the second part of September isn't good for stocks. And these are the dates over here on the left, and these are just the daily returns that were seen during the month of September. And, you know, some of them are down pretty significant. Others are virtually unchanged. And then the Magnificent Seven outperformance that peaked in July. This is when I remember talking about this in the videos. It's like there's only a small group of stocks that are really driving things higher, and they're still doing okay. And we're still watching them very closely, and they are coming back up now, but they have not come nearly back to where they were before. And over half of money managers here, they'd say that there'll be no recession for the economy in the next 18 months. Okay, we'll have to see if that changes going forward from here, because that's what the market's expecting. So, and then when will it happen? Well, 21 think in the first half of 2025, 14% think it'll be in the second half. And of course, you can always throw it out into the future, kick the can down the road. 8% think that it'll be in the second half of 2024. So there's still some people that are pushing for that, but not as many as had been in the past. And weekly flows into cryptos, we're seeing money coming out right now as that area has been under weakness. Then the 2-year treasury yield, less the effective funds rate, we're coming in pretty low here. And so this is just showing how interest rates are continuing to decline. And then the US core CPI ticked slightly higher in August. We're turning back up just a little bit here. Now, overall, we are declining. And this is the one that the Fed really pays attention to. We want to see this continue to decline if we're to remain more positive with the inflation outlook. And then global market implied, and how they do this. Let's see, ERPs here. I'm going to skip over this one here. Okay. And then the risk appetite is just down right now as the market had been under pressure. This is looking at the latest reading of sentiment at 70.76. It's still positive for right now, and that's more or less lining up with where we're at. And then big up week on the heels of a big down week. This, and on the next slide here, but you can see where this is marked. Here's where I have looking out a month, 3 months, 6 months, and 12 months going forward. And we tend to see positive returns when that happens. The insider transaction ratio, it's actually becoming slightly bearish here. And I don't have the other chart that goes with that. I'm trying to keep these videos a little bit under control. And instead of just reading through this chart, the thing that I've really been focused on is, why is the Fed cutting rates? Is it to stimulate the economy and inflation is under control? That's where they can come in and try to fine tune things, and it's more positive for the stock market. If they come in and cut rates because we had a great financial crisis because of the COVID lockdowns, or a terrorist attack, or something really bad happens and the economy falls apart because of that, that produces a whole different context. And when the Fed cuts rates for that reason, the market's probably already going down anyway. They're just trying to lessen the blow at that point. And that's really the takeaway that I get from this chart. Okay, equity positioning, we're still above zero here for the most part, even though it's been coming down with this latest reading. Discretionary, meaning you can pick and choose and move things around a little bit. And this tends to hold up better when we're going through down times. Or the systematic approach, it tends to do better where you just say, okay, I'm going to stay in the S&P 500. I'm going to keep adding money to it all the time, because then I'm going with the long run look here. And over a period of time, that will be more beneficial for that. But when we do see some down times, we tend to do a little bit better. But you notice right here lately, as the market has been trying to bounce back up, well, the systematic approach, or the discretionary folks, they're still more bearish, where the indexes have been going back up. So lately, this has been performing a little bit better. Okay, a weaker dollar, it augurs well for the global economic cycle. We've been talking about that in every video, how the weaker dollar, especially in the US, but also globally, stocks like that. The mega cap growth and tech positioning right about here is still positive, but well off of the high levels we had been seeing. And then this is the financial equity funds, stock funds, the biggest outflow. Okay, we start hitting the skids when the market's going down. People start yanking money out of there pretty quick. And then this is the quarterly earnings per share seasonally adjusted log. This is what we follow longer term. As long as earnings continue to go up, then that justifies higher stock prices. Okay, and I don't have, this is not a Twitter chart. This is one chart that I usually show over the weekend. And over the weekend, we were at 50-50 at, is there going to be a 25 basis point cut or a 50 basis point cut? After Tuesday's session, we're now at 61% for the 50 basis point cut and at 39% for the 25 basis point cut. There. Here's our chart where we were pretty flat. Things were, I was trying to keep at least somewhat of an eye as to what was happening in the market, but I didn't have access to all my usual charts. But it was a pretty ho-hum day. And then kind of on the heels of the retail sales report, we did see a higher open, but then that we quickly gave all that back. We went negative and found support down around the daily pivot, but then bounced up to go slightly positive into the close. And we were higher with the futures here, showing some real strength. And then we gave a lot of that back as the day went on. And we're pretty flat right now as everybody's kind of waiting to see what will happen. We're still a little concerned about this because we see the red line above the blue line here. They're both going up and improving, but this means that value is outperforming growth on an intraday basis. And this is another area that's a little bit of a concern to us because we started to come back up. Now we're flattening out a little bit when we look at the S&P growth to value ratio intraday. Here's our end of day chart. Growth was up where value was down, but neither of them were changed all that much. Growth was up more with the mid caps and also up more with the small caps. So, and these are going to be a little out of order because I'm in a strange place trying to put all this stuff together. We're coming back down to the 250-day moving average here when we look at the growth versus the value ETF. We're also not showing a lot of strength right now with S&P growth to value. The small caps are not really showing any strength, and the mid caps are not showing any strength. This is a concern to us, and we're wondering, is this going to change things? Growth stocks like lower interest rates. And or if we switch over into more of a negative environment, then the more defensive stocks tend to hold up better there. And that would explain what we're seeing in these charts. The value is actually holding up better right now than growth. And discretionary to staples showing a little bit of improvement, but not an awful lot of strength currently. Large cap growth, though, is still above its 50-day moving average, and it was up just barely. And here's the condition of our trend. This is the ADX. It's below 20. That's the black line. And it's below its moving average with the green line on top. But we're still not officially trending yet. Here's the short term. We're trying to turn up here. It's trying to pick up a positive trend. But we're going to need to see more follow through to really turn the ADX so that we get an actual confirmed trend. And we're below average with volume. And we're still kind of topping out here with the ulcer index, but we're above the moving average, showing that fear is still there, according to this chart. We ticked back up a little with the VIX on the line chart, coming back up to the moving average. And we're also just a really slow day for the VIX as well on the bar chart. And so pretty much flat, but around the moving averages with the VIX of the VIX, with the bar chart and the line chart. The momentum of the VIX is now down. But the seasonality for the VIX is up, and that means stocks are going down. If we fit into that same seasonal pattern this year, we are getting something from the SKU index. The market is expecting some kind of a big move. We're not sure. According to our charts, they're looking positive. According to seasonality, that could be negative. So the market is just as unsure as well, but the market is now expecting a big move based on this chart. We're declining with the equity put call ratio. Didn't see an awful lot of hedging ahead of the Fed meeting. And so we're going down with the 10-day and the 5-day. These are out of order as well. And we're kind of starting to get extreme here. If we drop below this red line, that quite often can mark a top in the market. So you want to be aware of that one happening too. We declined with this fear gauge as well as the other fear gauge. We're still more or less going up here with the risk on versus risk off, but we want to see this going up if we're more positive on the market. If we do end up turning more negative, we're going to see this ratio going down. And the volatility risk premium still in the band, even though it ticked up a little bit on Tuesday. We're still looking good here with the advanced decline line based on price, just coming out to highs here, even though we were flat. We are looking good based on volume. We actually broke a little bit higher on Tuesday. And we saw just a really big surge of new highs here and a drop off, but we're starting to turn back up with the 5-day, and we're still declining here with the 10-day. But this is another internal measure that suggests, okay, things are looking pretty good for the time being for the S&P. We're positive here with the advanced decline ratio above 0, and we're above 0 here based on price as well as volume with the advanced decline ratio. We came down a little bit with accumulation distribution, but we're not necessarily extreme. We're still positive since we're above the moving average. But this is a concern. I pointed this out after Friday. We had an up day, and the chicken money flow declined. We've been continuing to go down here. We had a little bit of an up day on Monday, but we went down on Tuesday. Now, some of this can be explained by below average volume, because this indicator uses price and volume together. But you see where the red line is continuing to fall. It's positive, and it could change. It could switch back to looking more positive. But for right now, we've seen this over the last couple of days, and it's a bit of a concern to us. The Chaikin oscillator, after going up into this initial extreme positive area, it came down a little bit, but it's still positive there. The vortex still has a green line above the red line. And it's not so much now that the green line's going up, it's that the red line's going down. And this is very interesting here. The S&P 500 advanced decline line based on a cumulative basis, we are breaking out to a new high, and we're also breaking out based on volume. That's seen as more of a confirmation, where we have not broken out to a new high yet based on price itself. And we're still looking positive here with the new highs minus the new lows. And then the 50-period moving average, where it had been going down, now it's starting to go back up. This is more intermediate to long-term, suggesting good strength in the S&P. And we're doing good when we compare the S&P to the NYSE advanced decline line. They're holding up quite well. And here are the new highs minus the new lows for the NYSE, also going up. Also seeing a positive sign here on the daily chart for the new highs minus the new lows. But look at this. The cumulative advanced decline line for the NYSE on price just shot up like crazy, busting out to new highs here with the regular NYSE advanced decline line, also breaking out with this other NYSE advanced decline line. And then based on common stock, breaking out to a new high, based on volume, breaking out. So the broader market is doing quite well. It's the lagging that we're seeing with the mega caps and the semiconductors right now. Even if they have a good day, we need to see many good days in a row to really help the S&P. And then here's the 5-period moving average of the highs minus the lows, continuing to be positive. And we're still going down here when we look at large caps versus small caps. We actually declined a bit with this ratio as small caps had a little bit better day. We're looking good here with the advanced decline line, going up with the NYSE common stock, flat but still looking positive with the S&P, going up with the mid caps and the small caps. But you notice we're breaking out of this previous high here with the mid caps. We have not broken out above these previous 2 or 3 highs here with the small caps. So here's our daily chart. Really not much to show here. We're still looking good. If we really scream to the upside, we'll be watching this R1 level as a pivot point that could be overhead resistance. We're above the 50-day moving average, but we continue to be below average with volume. And we're going up, but kind of flattening out here with the 20 period based on the S&P, but we're just barely extreme positive based on the 50. We're just a little bit under being extreme with the 200. And the boom indicator, it's not extreme in its distance away from the 20 period moving average, but it's really showing an improvement here with the distance away from the 50 and the 200. So this is still looking pretty good for the time being as well. And the condition of the short-term trend based on 20 periods, above the lines are going up. That's positive. Above both the simple and exponential moving averages, that's positive. Now, you could say extreme positive or just good momentum with the Stochk RSI. The Williams percent are, even though it declined a little bit there, not quite extreme with the CCI 14 and still going up but positive with the CCI 20. The stochastics rolling over just a little bit in the short term, still looking extreme, but positive in the intermediate term, and also getting back to extreme and positive in the long term. The force index is positive since it's above 0 in green. And we're just right on the border between the +1 and +2 channel of the standard deviations chart. Tick down a little bit, but still positive here with those stocks in the S&P above their 20-period moving average. And so we're watching this 70 level. This is just showing good upward momentum here. We'll keep an eye on this. Are we going to see any more follow through to that? We're going up with those stocks above their 50-day moving average, 100 and 200-period moving averages. And so the balance of power declined, but it's still above 0. So it's positive. This is the CMB composite. We're above this black line. I always like to do this. I put the black line on here. I just kind of eyeball this and say, okay, this is about where we start to look extreme positive before we get ready to roll over here. And sometimes we can go more to the upside. Sometimes we roll over just when we barely got into this area. But this is looking extreme right now. And the condition of the 50-period moving average above both lines, and both lines are starting to go back up. We're above both the simple and exponential moving averages. The go, no-go is positive with the blue bars. And we're coming up to the blue line here. Now, it's going to be even more positive if we do break out to see the blue line turn and go up. Right now, it's flat, but we're above the midpoint. We're still positive as we're dealing with previous all-time highs here. Of course, some people can say, justifiably so, we made the all-time high. We almost came back, but didn't set it. Is this a double top? Well, now, if we start going down from here, people are going to say a triple top, and that could be seen as negative. And we're just not seeing much right now from the TTM squeeze. It's not going down anymore, but it's not really turning positive at this time either. And the ease of movement is improving, but it's still below 0. That's still negative. The Arun just shot up, and it's actually extreme positive now. It measures the difference between the green line and the red line, and it's getting really extreme at this point, but that's still positive. The S&P McClellan oscillator declined, but it's still above 0. So we're still going up based on price and volume with the summation index for the S&P. And we're slightly down here with the NYSE McClellan oscillator, but still positive. And so we're going up with the summation index based on price and volume for the NYSE. The Swenlin trading oscillator, positive based on price and volume and advancing. The momentum is now turning a little bit more positive here, turning up with the PMO, turning up based on price, and we've already crossed above the moving average based on volume. Actually declined a little bit with the PMOs that are rising, but the buy signals are still going up, and the PMOs above zero continue to advance. We're positive with the Elder's Impulse system with the green bars. We're positive with the parabolic SAR. Here's the MACD showing momentum. Here's the slope oscillator starting to cross back above its moving average. So we're turning up in the short and intermediate term. We haven't really started to show much of an improvement here in the long term with the KST, but the TRIX is starting to roll back up just barely. And we're looking better, but still negative with the Copic curve. We're entering the initial extreme positive range now with the Sean trend meter. We're above all the plotted moving averages. And the bullish percent index is above 70. Now, we can go higher than this, but sometimes this is when we start to really take note that, things are getting a little too extreme. And we were flat, but we're still positive with the NASDAQ 100 bullish percent index, going up and above 50 with the NYSE bullish percent index, above 50 with the money flow, that's positive, and getting extreme positive with the ultimate oscillator. We're positive with the on-balance volume. We're above 50 with the RSI 14 and 9. And we're well above this R2 pivot level based on the weekly chart here. And these last for an entire quarter. So this is pretty significant right now that we're above that. If we do start turning down and we drop below that, that's also going to be pretty significant. Okay, we're turning more positive here with the Heiken Ashi based on trend. We're positive with the Renko. We're switching back over to positive now with the Kigi chart. It's going from red to black, and that's positive. And we're positive with the 3-line break. We added another X here with the point and figure chart. That little upsurge that we saw early on Tuesday, that was enough to draw in a new X. And you can see 3 of them right here. Triple top. Ooh, ooh, ooh. Somehow that'll get rectified here. We're looking extreme with the 150 and 200, but as I always say, that could be good long-term momentum. We did see a thrust up here, but this is not a ZWAG NYC breadth thrust. It has to go down below 0.4 and then within 10 trading days shoot above. So this one was erroneously cited what was this, back in August or July, and then another one in August. And people are saying that this is a valid signal. It's not. It has to go down below 0.4 and then within 10 days get above this red line. But I mean, this is positive, but it's not an official signal. All right, we're positive across all time frames with the Keller market model with all the indexes. We changed over to positive with the commodities, but they're still negative in the intermediate and long term. And we're negative across the board here with the dollar. And I'm including Monday and Tuesday's alerts here. Real estate, they like lower interest rates. The BPI above 70, that was triggered on Monday. Oil got above 70, but then ended up dropping below 70. The NASDAQ is crossing levels. Canada's doing quite well. The Dow set a new all-time high intraday. Discretionary, this is good. Set a new all-time high. That helped. That's the growth part. We want to see that doing well. And the financials are doing well. They have a BPI above 80 now, where the S&P, it had a new intraday high, but not a closing high. And healthcare, this is defensive. It's also crossing above 70, and the dollar going down. That's also been more positive for stocks. And Canada set a new 4-year high. And we're looking pretty good here when we compare the S&P to the equal weight version of the S&P index. And we actually declined just a little bit as the mega caps did a little bit better there. Actually, it's the other way around. The equal weight did a little bit better than the weighted version. And the Dow intraday all-time high, but closed actually lower on the day, but still positive with the Elder's Impulse system for the diamonds. We're still above the 50-day moving average with the NASDAQ and NASDAQ 100. We're positive with the Elder's Impulse system for the Qs. We're positive with the momentum for the NASDAQ 100 above all these trend lines with the QQQs. So we're hanging in there right now. The small caps, now this is a little bit scary. They gapped higher, went up and closed just a little bit off of the open. That's not usually a good looking bar, but we'll have to see if that gets rectified. And small caps are not breaking out yet above these previous highs, but they are looking better. They're positive with the Elder's Impulse system for the small caps. We're above the 50-day moving average. When we look at the Russell 2000 small caps, we're above 50 and going up at the RSI, and the momentum is turning back positive. And we're above the 50-day moving average and above this pivot level still with the mid caps, showing some improvement, but not breaking out yet. And they're also positive with the Elder's Impulse system when looking at the mid caps. The Wilshire, this is still above its 50-day moving average. That's a broad market measure and not setting an all-time high, at least yet. And we're looking good here with our total U.S. stock ETF. So things are looking good. Can they stay that way, even if they become more overbought or extreme positive? And we're kind of bouncing around, but we want this to go down, actually. But we're seeing a golden cross here with this ratio, meaning on a trending basis, staples are starting to outperform the tech sector. And that is a concern to us. When this is going down, that means tech is outperforming. This going back up, that means the market is getting more defensive. But the financial sector is still looking good, up over 0.5%. And the FANG index, even though the line is going down, we're still above the 50-day moving average. We're still in between this longer-term trend line and the shorter-term trend line. Apple is still below its 50-day moving average. Amazon's above its 50-day moving average. Microsoft was able to climb back above its 50-day moving average. And we have NVIDIA right about on its 50-day moving average, down a little over 1%. Meta looking good, looking pretty solid on a trend basis. Google, after dropping below its 200-day moving average, has now been able to stay above that. And Tesla is right about on its 50-day moving average and recently gave us an uptrend. Netflix also looking good, but is not necessarily broken out to a new closing high. And we're seeing the short-term relationship between U.S. stocks and world stocks starting to fall, with a longer-term relationship is still pretty solid. Oil dropped down below 70. It's now at 69.96 after going above 70. And the dollar is in a downtrend, which could be helping stocks. We're going up now with the 10-year based on yield, but the overall trend has been down. And we're going up with the ETF, and that has been in an uptrend based on price. We're still looking okay here with the 10 to the 2 yield curve. We still have a long ways to go with the 10 to the 3-month yield curve to go back to being uninverted. And I wanted to point this out. This is the market still anticipating a soft landing, not as convicted in that as they were before, but we're at least at the high end of the rainbow here. But when we look at a broad market measure of short-term bonds, we're breaking out of the rainbow. Another broad market measure, longer-term bonds, also breaking out of the rainbow, but not to new highs yet. And home construction is breaking out to a new high here compared to 3 to 7-year bonds. This area is showing a lot of improvement. Now, this is something that we're watching. We don't know if it's a big deal or not, but we're really coming down here with the 3-month yield. And I usually only cover this in the weekly video, but because this is happening, we want to really watch this, because this is what happened in 2007 going into 2008. The context for this is different now. So to try to make a straight comparison that what happened in 2007 into 2008 is going to happen this time, we can't do that. We can only see the similarities between the two and then see, okay, are things going to develop that make it go back into what we saw in 2007 into 2008? And then we're looking at growth of value, not really doing all that great here with Qs to the S&P. We are looking better with discretionary to S&P, and that's encouraging, but we're coming back down to the moving average when we compare large cap growth to value. And with the large caps coming down to the moving average, on the moving average, and declining now with the mid caps and going below the moving average with the small caps. This is also not really encouraging. S&P is not outperforming utilities right now. We want this ratio to go up. It's actually been going down. And this is another area, the 2-year yield also really declining. That has been giving some good support to stocks. But if this keeps going down, 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 the context of that just might change. And we're coming down now with the Staples to S&P 500 ratio, but we have really been going up overall. And this going up is more negative for the S&P. This coming down is more positive for the S&P. And then we want to update the Hindenburg-Ullman chart here. If you need to learn what that is, there are really 3 criteria, and it's all outlined here on this slide. Here is the confirmation. We saw the first signal on September 5th. The second signal came on September 12th. And we're just waiting to see if more spikes will come in. That would just confirm what we're seeing in this chart. And other times when this happened, this is before the COVID crash, this is before the big bear market, the cyclical bear market of 2022. This happened at the end of 2021. So our technicals are still positive and improving. We do have a confirmed Hindenburg-Ullman, but we also have weak seasonality to go into this whole mix. So there's some pretty powerful positive things. We have to look at our charts, but there's some other things that could be quite negative for the market. We're just not seeing that happening, at least yet. We're going to get the MBNA Mortgage Applications Index, housing starts and building permits, which is a leading indicator. And then the big thing is the Fed decision at 2 p.m. Eastern. And then all the different crazy stuff going on in the world in case that impacts things. And then we're going to get the weekly jobless claims. That's bigger and bigger now because we're keeping an eye on the employment situation area. We'll also get LEI. We're not going to have any economic reports on Friday. And here's just a block around the big reports coming out on Wednesday. Seasonality, we're neutral to negative, just going back the last 20 years for the Dow, S&P, and NASDAQ. And we're in options expiration week, where we tend to be up more than down. Keep in mind, the week after options expiration, we're down a lot more than up. So, and that's one of the things that I was posting on the website. It's after options expiration when things can really turn negative. Well, options expiration is this Friday. So next week is when things potentially could get negative seasonally. And this just shows where we're at right now. A few days left, but then this is when we see some negative seasonality coming into the market. Wednesday, based on what happened in 2023, that's the most negative day of the week. But in 2024, it's not the best. It's the worst day of the week, but still positive. And this is where we're coming into that weaker seasonal time here. Also, some weak seasonality showing up in this chart. And so our warning signs. We do have a confirmed Hindenburg-Ullman. We do have weak seasonality. Doesn't mean that's going to happen, but it has happened before. We're watching the defensive areas like staples, utilities, and healthcare, keeping an eye on energy too. For me, that's more of a geopolitical thing. And then the oscillators for the S&P are turning positive. We're still not there long term, but in the short and intermediate term, we are positive. The ease of movement is negative, but it's improving. The copy curve is negative, but improving. Growth of value, just not really helping. Discretionary to staples had a pretty good day, but we need to see more for this to keep continuing to improve. And we do have accumulation distribution, the Chaikin money flow, but it's declining. That's that little warning sign I pointed out. The Chaikin oscillator coming off of an extreme reading, but it's still positive. The equity put call ratios on the 5-day and 10-day charts are going down. That's positive. The advanced decline line is still looking pretty good, especially for the NYSE. And we have the S&P and NYSE McClellan oscillators and summation indexes, which are positive. The Swenlin trading oscillator is positive. The parabolic SAR, the bullish percent indexes for the S&P, NASDAQ 100, and the NYSE. The Vortex, the money flow, ultimate oscillator, that's a little extreme now. And the momentum based on the PPO for the NASDAQ 100. Financial sector looking good for right now. So our conclusion, we are positive and still improving, but there's a confirmed Hindenburg-Ullman. We are coming into a time of historical weak seasonality. And what is the reaction going to be to the Fed? And that's really what we're looking at for the short term. It could just last on Wednesday. It might spill over into Thursday. It could have more momentum behind it, either positive or negative, and spill over into more the intermediate term. We're positive, but here, and I've said this 4 times now, the Hindenburg-Ullman and the seasonality, but we're still positive in the long term. But we could be looking extreme with those 150 and 200-day moving averages. Thank you. I hope you found this helpful. Thank you for putting up with the changes that I've been doing here. Have a really good day, and I will talk to you in the next video.